Let's do a easy question, guys. When you talk about the question, the nominal risk-free rate is best described as the sum of the real risk-free rate and a premium for what? Right, what is the premium for, guys? We have premium for uh, nominal. Nominal, we have premium for what? Please understand, nominal, we have premium for your inflation, right? So the inflation is the premium, right? Luckily, CFA only has three options, guys. That's a good thing about CFA. FRM and all has four options, so chances of getting a right option is good. Nominal has your risk-free rate, which I told you, nominal risk-free rate. Sorry, the real, not the nominal one. Hmm. So we saw just now in definition, very easy. When you are trying to find nominal, nominal is your real risk-free rate plus what is the thing? Expected inflation, right? Inflation is the thing, right? Remember the rest three: default, maturity, and liquidity are case by case basis. These are case by case basis. Main main two are these only. Real and inflation are main two. This is case by case basis. Okay. This is case by case basis. That's why I told you 2 plus 4 is 6%. This is main. Then depending on case by case, right? So main is real risk free rate plus inflation. Rest these three will depend on if there is certain case or not. Generically, just simple scenario. This is your real risk free rate and a premium for expected inflation, right? See. So easy question, very easy, straightforward question. I don't think anybody should feel any problem here. Okay, so that's we have discussed, guys. I'm just moving ahead in easy question. If you have any doubt, please ask me. Next one is, which of the following risk premium is most relevant in explaining the difference in yields? Wow, this is what we discussed just now. Very interesting question, guys. Very interesting question. These kind of question comes in exam. Which of the following risk premiums is most relevant for explaining the difference in yield between a 30-year bonds issued by US Treasury and 30-year bonds issued by small private US corporation, right? See, both bonds are your 30-year, right? So both bonds are 30-year. Now, in this case, one bond is of US Treasury. Now, US Treasury is basically US government bonds, right? US Treasury is what I showed you right now. The Bloomberg, which I showed you, that was US Treasury, right? So that is very liquid because there are a lot of participants, right? Liquidity is very high, right? When you have your small private US corporate issuer like Shapurji Palanji Group, let's say, I'm just taking India example, small private US corporate issuer. I'm just taking, let's say, Indian equivalent, right? It is like Shapurji Palanji Group, right? That liquidity will be low, right? Because not many players will be ready to participate there, right? So the basic difference is not inflation. The basic difference is not maturity. Maturity is same, 30-year and 30-year. Difference is liquidity. Okay. If you are new to the world of finance, sorry, I didn't ask your backgrounds, but if you're new to the world of finance, you might face little bit issues here to understand. But if you already know what it is, you will understand, right? But overall, the point which you need to keep in mind is that US Treasury is like a benchmark, and benchmarks are, the amount of money which is traded in US Treasuries is trillions of dollars, not billions, trillions of dollars. Trillions of dollars are traded in US Treasury. So liquidity is not high. I would say extremely high, right? A lot of buyers, lot of seller, international buyer, international seller. But when you go to a corporate bond, right, they're not buyers and less buyers and sellers. That's buyers and sellers, and that's why price is kind of illiquid, and that's why there is liquidity low. Anybody in doubt can ask me, but I hope you guys know what is US Treasury market. Are you aware of what is US Treasury and corporate issuer, like uh, some idea? Yes or no? Anyone who doesn't have idea about this
Yes,
thing?
sir.
You have now, right? So yeah, so US Treasury bonds are highly liquid, where the bonds are small, issuer trades infrequently, and the interest rate includes a liquidity premium. That's what I told you. The liquidity premium reflects the relatively high cost as selling a position 2 months on the same maturity was same, right? Maturity was same. Inflation premium embedded in the yield of both bond is likely to be similar given both are US based, the same maturity, right? So try to understand, try to get to the meat of the topic. You will get the idea. Let's do the question here, right? Consider the annual return for fund Y, right, over the past 5 years. Year one is 19.5, year two is minus 1.9. 5 different years, 5 different returns are given. Now they are asking you geometric return, right? Geometric return for fund Y is closest to, again, geometric return, compounding return, under root they have to do, right? So that's what we have to achieve, right? So, and same thing, if you just, for you guys, I'm taking you back to the formula so that you remember it. It is 1 plus R1, 1 plus R2, 1 plus R3, 1 plus Rn, minus the bracket, the under root finishes at 1 plus Rn, then take the root n and minus 1. So in this case, we will have root 5. Right? In this case, we will have something called root 5. Right? Root 5. And then we have 1.195, right, into your, obviously it will be subtracted, so it will be uh, 1 minus something, 1 minus, so 0.981 would be there, not 0.981, uh, yeah, 0.981, right, and then 19%, 1.197, right, and no, it's 1.9, so point, sorry, 0.81, 0.81, sorry, 0.81 would be there, 0.81, just a second guys, 0.81 would be there, and this will be into 1.197 into 1.35 into 1.057, right? So you take, multiply all these, take the fifth root and minus 1. All these have to be done in calculator, guys. Let's see the what they have done, right? This is what they have, right? So same thing which I told you. You have to, again, this all things have to be done in calculator, guys. 1 plus this, 1 minus this, right? This one raised to power 1 by 5 minus 1, right? 1 minus, I think the number I'm putting wrong. 1 minus 0.019, sorry. 1 minus 0.019. I think at least the first number I have taken was right. So just be cautious here, guys. Use calculator, right? You saw yourself that I did a stupid mistake. Not 0.81. Earlier I written correct 981. Right. So simple, straightforward, not very difficult, right? So you can do it. So that is one. Let's do next question. A portfolio manager invest euro 5,000 annually in a security for 4 years at the following purchases. Again, see, purchase price, this should give you a hint. Purchase is mostly for, you have to see that some person is investing annually security for 4 years at the following, right? So, how much he is investing, right? And whether he is investing your equal amount or not. So I told you very clearly, when you are investing equal amount, so portfolio manager invests euro 5,000 annually, What was that equal amount investing, guys? What was the best thing to use there? Which one? Arithmetic?
Harmonic.
Harmonic, right? So even though you don't have to even solve the question, right? It comes out automatically that okay, equal amount investing, right? The best thing to use there is harmonic, right? We can obviously solve it, but the point is that it you should click your mind immediately that geometric is more for compounding, right? This is for straightforward, simple way which is less used, right? But when you have to equal amount investing, then it is harmonic, right? And then how do you find out this? Then you have n divided by 1 by x. That is what is happening here, right? See, so n is 4, right? And then 1 by x, 1 by 62 plus 1 by 76 plus 1 by 84 plus 1 by 90, right? Then it came out to 76.48, right? So that is the thing, right? So the formula for harmonic mean was n summation, right? 1 by xi, right? I told you 1 by xi, right? So you have to solve it, okay? So that is what we have. So pretty straightforward. Go back and practice it. Obviously, you will get the notes, etc. But go back and practice. Let's do a theoretical question. Which of the following statement regarding arithmetic and geometric means is correct? Right. So let's try to understand it. The geometric mean will exceed the arithmetic mean. No. For a series with non-zero variance. No. Geometric mean, I told you, will always be less than arithmetic mean if it is unequal, but if it is equal it will be equal, right? If all the numbers are equal it will be equal, but it never exceed, right? It will never exceed. So this goes away. The geometric mean measures an investment's compound rate of growth for multiple period. That seems okay. Arithmetic mean measures an investment's terminal value over multiple periods. There is no question of terminal value, right? Because we never discuss any terminal value, right? It's just a simple average, right? It's not a right. It's a simple average. Arithmetic mean is simple average. There is nothing, no concept called terminal value, right? So option is B. Guys, that the CFA has this good thing that there are three options. FRM and all has four options, right? So it becomes more difficult and challenging there four option selection. Here at least, the getting each option right is 33% chance, right? It's a B1. Okay, same thing, more accurate. Just read the answer. Geometric mean compounds the periodic return average return, giving the investor a more accurate measure of the terminal value of investment. So now this part we missed out, right? Just understand your geometric, right, gives how money actually grows, right? Arithmetic mean is just about a forecast, right? Expected 1 year return, right? And geometric mean is your multi-year return, etc. That we keep in mind, right? So that is what we have. So this is done. Now let's go to the questions, guys. In questions, a fund receive investment at the beginning of each year and generate return for 3 years as follows. They get USD 1,000, 4,000, 45,000, right? Big money coming in the last year. 15%, 14%, 4%. Which return measures over the 3 year period is negative? Now, see, you are trying to calculate, there are three kinds of return given here, right? So how do you go about it, right? See, when you are trying to find intuitively, right? Before I get into the calculation of each, intuitively, please understand, uh, when you are trying to calculate such kind of question, you need to be very clear that can I get the answer without going into calculation, right? So, or can I make it easier to understand? See, geometric, we just studied. If you go to the previous slide, we just studied that your geometric and TWR are same, almost same, right? This is the geometric mean of superior returns and it is TWR. So what you get from both of them is that these two, A and B, right? These two will be similar in nature, right? Because both are geometric only, right? This is geometric, this is time weighted, right? And time weighted is also geometric, right? Only difference is time weighted is geometric of subperiod. So if I calculate one, right, I will get an idea of the other also, right? So that is the best way to solve it, that you focus on this one first. And since you focus on this one first, you can easily figure out, right? So now the TWR or HPR of one is given as your 1.15, right? Or let's not say HPR, let's say, right, let's put it here. If I try to calculate your time weighted return, it is your 3 period, so root of your 3, and it will be 1.15 into your 1.14 into your 1 point. This actually, this is minus, guys. This is, maybe there is an error here. This should be minus. I think this is minus, right? So this is 0.96. You solve it, you get 7.97, right? So once you do that, right, you realize that okay, this my time weighted return is coming to me 7.97. So you're pretty sure, right, that geometric mean return will not differ too much out of it, right? So then I don't need to even calculate money weighted rate of return, because I know geometric mean and time weighted rate of return are almost same, right? Because time weighted return is also geometric mean return, right? So both are 7 point something. So that makes it easier for me to understand, right? Now, how do I calculate the money weighted rate of return, right? So for that, let's go ahead. I've told you an intuitive and easy way to kind of calculate. Now, money weight of return, consider both the timing and the amount of investment in the fund, right? So this is where your both things are calculated, right? So see, the calculation is very long. What I wanted to, and minus 4% also I told you, right? So what I wanted to show you here was that sometimes examiner is checking your understanding, right? Examiner doesn't want, see, even though this is calculated here, what I wanted to tell you was that you don't need to calculate so much. You just have an understanding that okay, if I time weighted rate of return is 7.97, that is similar to geometric, that will be also 7 point something. So if I, the only possible negative return can be money weighted, because first two are not possible, right? So again, the calculation here is this. The first one has been shown. The first one has been calculated. You can see new investment 1000, net balance 1000. The gain is 15%, 150, 1150. This goes here, right? 1150, new investment 2850, right? Because net balance, right? If you see here, here net balance is asset under management at the beginning is 4000. So if your amount was your 1150, the addition which has happened, this you have to assume, this you have to figure out yourself, guys. The addition which has happened is this, right? Nobody is telling you this. This you have to calculate yourself, because amount given was 4000, so you mean this was added, right? And then you earn 560, 4560. This is going here 4560. The final one is 45,000, so obviously this was added, right? And minus 4% USD, minus 4% is your 1800 of that. So final is 43200, right? So right, so you have to understand both timing and amount of investment to calculate the money weighted return. You have to tabulate the investment return, investment amount to determine the cash flows, and then This is how it is calculated, right? This is how it is calculated. uh, you have, I'm not sure if you have bought calculator or not. Have you guys bought calculator?
Yes.
Okay, to solve such kind of question, it is very important that we have good grasp over the your calculator, right? How calculator solve these concepts, right? So for, since we are doing the first question, we'll see the solution here, right? So I've shared the videos. I hope that makes sense, right? And in this particular question, right, we're trying to calculate your TWR, right, time weighted return, right? And in time weighted return, the important part to understand was that we have to input different cash flows and then calculate the IRR. Right now, what are different cash flows here, right? So if you see, right, if you see this table, so in this, if you go back to the first solution, right? So the year of investment, the asset under management, and of the beginning of each year, right? When I take beginning of each year, that is $1,000, right? The starting point I need to identify, right? The beginning of year it was $1,000. The beginning of year it was $1,000. So that is what I have taken. Beginning of year minus 1,000. Why I have put minus sign here? Please understand that whenever there is, you know, cash flows, right, the invested cash flows are generally taken as the negative amount. And this is also a very big confusion, guys. Negative and positive, right? So if you go back and see the table again, right, the initial investment, right, initial investment which you had, that is considered to be CF0. So if I write it here, the first investment which you got, the initial cash flow you got, right? So it is like you started the year at, when you, the first cash flow you got was your $1,000. Okay, so this money is you've got at present time, right? So it will be taken as minus value. Then you are talking about CF1. Now, CF1 is after the end of the first year, right? It is, this is the beginning, this is the end of the first year. Now, when I talk about the end of the first year, you see this is balance at the end of the first year 1150, right? So you go here, right? Now, is this the same amount? No. Why it is not same amount? Because ultimately this, you see here, right? You see here what is happening. How much cash is coming? This balance was your end of first year. Then the net balance at the beginning of the next year was 4,000. So you added 2850, right? So the amount which was again added, right, which was provided to you was 2850, right? Then same thing here, CF2. CF2 again, your amount at the end was 4560, but your new balance at the beginning of third year was 45. So how much was received? Right, received was minus 40,400. And then we talk about CF3. CF3 is the amount which is now with you at the end of the year. Now, this amount, these all amounts are received, that's why they are negative. Now at the end you have positive balance of 43,200, right? So this is what you need to identify very very clearly when you do it for the first time, that you need to be very clear that especially when you're calculating your time weighted return is the negative values what you are receiving and the positive value, right? So three values are negative and one value is positive, right? That is what we have here. Three values are negative and one value positive, right? Three value negative and one value positive, but I have also written. And then you have to put in the calculator, right? So then you have to input in the calculator. This is the equation which is given here, right? Which is minus 1,000 minus 2850 minus 4440 43,200. In your calculator you should, that's why I given you the videos, I hope you learned it. You have to put the values in calculator for each cash flow Don't forget to put the correct sign, because if you put the wrong sign, the answer will be wrong. And then you will compute IRR. And when you compute IRR, you will get IRR as minus 2%, right? So this is the IRR which is giving me the value, and you're equating it to zero, right? So don't bother about equation that much, because nobody will actually solve by equation. You will basically solve it by calculator, right? So remember that in calculator you put CF0 value, CF1 value, CF2 value, right? Be very, very clear of your signs, right? This is negative, this is negative, this is negative. CF3 is positive, right? CF3 is positive, right? Negative, 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 and positive. And when you go back to your solution, right, the question which you were doing, so if you right, if you go back to the question here, that we discuss again, right, that these two were very easy: 1.15, 1.14, 0.96, 7.97. And the question was that which of the three period the return is negative. Now if you see here, okay, the return is coming as negative, right? Minus 2.22, right? So answer here is IRR, which is coming by calculation, is minus 2.22, which is negative. Okay, that was the answer, right? So my point here is that learn, right? Learn from how to use calculator. That's why those videos were shared and one extra day was given. uh, the objective here is that you can't solve these questions by your equations. That cannot be done. These questions can be solved only easily by your calculator. You should know how to put the values. Those are given in your video. So we can't do that right now here, because you have to put on screen those things. That's not possible. Okay. Question number 7. At the beginning of year one, a fund has USD 10 million. Beginning of year one, right? It is not the end of year one. Beginning of year one, right? So it is always like your CF0, right? Same concept which I told you, that whenever you have, you know, beginning part, you start with CF0, right? This convention you have to understand, right? Please try to understand. So we have CF0, right? CF0 is given to you. And what will be the sign of CF0? Right? I told you, right? CF0, you are receiving the money when you started the year 10 million. So this will be negative 10, right? Negative 10 million, right? Under management. It earns a return of 14% for the year. Okay, fine. So first year 14%. The fund attracts another net USD 100 million at the start of year two. So money is coming again to you, right? Again, money is coming to you, but it is not your money. It is coming to you, right? So same like earlier question, CF1, right? And why I'm taking CF1? It is because the see, keep in mind very clearly, beginning this relationship, please try to remember. Beginning of year one means end of year zero. Beginning of year two is basically your end of year one, right? We always, when we write 0 and 1, this is end values. Please remember this very clearly. In calculator, when we input the end values. So when I am saying to you, the fund attracts another net USD 100 million at the start of year 2. Start of year 2 means end of year 1. So end of year 1 is written like what? CF 1. Beginning of year 1, 10 million, right? Beginning of year 1 means end of year 0. End of year 0 is written as CF0. This convention, please understand, guys, because you are basically trying to use a computer, right? And computer has a kind of algorithm, right? What is a computer? Computer is your calculator, right? So you have to put in the values what your calculator understand. Calculator understand values like this. right? So you have to put values like this in calculator. Okay, so keep that in mind. So CF1. So don't get confused, right? Don't think, sir, why are you doing this? I am doing all this because calculator understands like this, right? So CF1 is equal to, again, since you are receiving that money, it is negative sign 100, right? And earns a return of 8% for that year. Fine. The money weighted rate of return of this fund is most likely, right? Now we have to calculate the money weighted return. Right? Again, same concept, money weighted return. We have seen just now how money weighted is calculated. We have to calculate the IRR. It is done by your, you know, what you say, the calculator. Now, but the question comes is, what is CF2, right? How do we get the CF2 value? Because CF2 value I don't have, right? What is the difference in this question and the previous question, right? Previous question you had CF2, right? In the previous question, the last value was given to you. Yes or no? Are you getting my point? The last positive value was given to you, na? 43,200, right? This value was given to you, right? So last positive value given to you, if you read the question also, right, you understand that last positive value is given to you, right? It is, you have the, uh, if you see here, right, by building this table, right? Okay, so here also, to be fair, okay, here also I should have shown you calculation. So what has happened is 45,000, then minus 4 has been done, right? 44, you know, if you have, so how did we get 43,200? We have calculated it, right? How did we calculate this thing? 45,000, the ending value, multiplied by your, loss of your 4% minus 0.04, right? That's how I calculated the value of 43,200, right? So I need the ending value. Now the question comes is that, okay, here the ending value I calculated, right? Here the ending value I calculated using whatever values I had, right? Same thing I have to do there also, right? So what did I do? 45,000 minus 4, 43,200. Now, how do I calculate there the ending value? I don't have the ending value. I only have the starting value. Let me delete this thing. So in this part, right? Sorry, I don't want to go ahead. But the whole point here is that how do I find the now your ending value, right? So ending value, how do I calculate is that I know I have received 10% first year, that earns your 14%. So that 10 million which I first year came to me, in the first year it earned 14%, 1.14, right? In second year, that 10 million earned 8%, which is 1.08, right? So this is the what your first 10 million earned, right? First 10 million earned 10 into 1.14 into 1.08. Then what is the other amount of money I have got? Other amount of money I have got is 100 million. 100 million I have got, that earns what? That earns 8% in the second year. Because that came in the after the first year, na? That was not there with you in the first year. That came after the first year. So we only have 100.08. Now if I solve this, if I just solve this, because the numbers are very simple, right? Numbers are very simple. If I just multiply and solve this, I get the value 120.31, right? In my calculator I get the value 120.31. So this value is the value of the ending value, and this is your plus value, right? So this is my ending value. CF2 is equal to your 120.31. Okay. Now you put in the calculator. Same thing. You input in your calculator CF0, CF1, CF2, two negative values, one positive value, and compute IRR. Right. Put the values in calculator and compute the IRR. Right? Put values. Again, little tricky, guys, but please understand, this is what you need to practice. We are giving you very solid questions. These all questions are actually from CFA, end of chapter questions, right? Right. So you are actually practicing good question, right? You don't even need to go home and kind of do it again, right? So these are hard questions. So do less question, but do quality questions, right? Don't do very easy question, right? That is what, right? Negative value, why it is there? I have explained you. How did I get this value? I explained you, right? Because 10 million earned this much plus 100 million earned this much. You added, you got your 120.31. Then this is the equation you are getting, right? Actually this should be, is equal to, right? And then you just compute IRR by calculator, use calculator, right? So use calculator to compute IRR and you get 8.53%, right? This is your money weighted return. If somebody asks you that please calculate the time weighted return also, right? Time weighted return is very easy, right? Why time weighted return is very easy? Because first year, the first sub period, right? You asked me now that what is the difference between your geometric mean and the time weighted. So first sub period, the return was 14%, 1.14. Second sub period, the return was 8%, 1.08, right? And you take the under root, which is that's why you have this, so 10.96, right? So these kind of questions are very important to understand. This is the first chapter. Go back and practice it. But the whole idea is given here. Okay. All right. Please ask your question if you have any doubt. But overall objective is same. We have the practice question now, so we'll try to solve it. An investor is evaluating the return of three recently formed ETFs, right? Selected return information on the ETM is presented below in the following table. One is 125 days since inception, second is 8 weeks, third is 16 months. And returns are 4.2, 1.95, and 17.18. Now, the question is which ETF has the highest annualized, right? So you have to communicate to client, right, that my ETF is performing well, right? And this is the real example, right? This is the real example. This is the problem because let's say Goldman Sachs, right? Goldman Sachs has launched an ETF. One is launched in July, one is launched in September, right? Which is performing much better than the other one, right? How do you communicate, right? So that is the point which comes that communication is very important, and to do that, it is very important to understand that what is the formula, right? And this is what I told you in the previous slide, that you have to do 365 by days, because this is this is the return since inception. Now which what is this return since inception is holding period return, right? This understanding you need to have, that this return is holding period return. Now how do we go from, so basically concept here is how do we go from HPR, right, from your HPR to your annualize? Is there a formula to go from HPR and annualize? Before we even start the question, we need to understand what exactly examiner wants us to do. Examiner wants us to move from HPR to annualize. So let's go back and see whether we have seen any formula from HPR to analyze. Yes, this was the one. 1 plus HPR 365 by days minus 1. Right? The first formula, right? This one, the top formula. So if this is the formula we have, right, we can use it, right? This is the formula we have, right? Okay, so we can use this formula. So HPR is given, so it becomes 365 by days minus 1. Very easy, right? So how do I do it? For the first ETF, right? For the first one, if I try to calculate, for the first ETF, if this is the thing, your 1 plus HPR. What is HPR? Is 4.25, right? So that's 4.25%, right? So you can write directly 1.0425, right? And then you have your 365 by days. So 365 by your 125 days minus 1. So this is the first one, do the calculation. Second one, your again same thing, 1.0195, right? I have added 1.95%. Again, 365 on the top. In denominator, 8 weeks, you have to now see the convention. Should I use for 8 weeks? What should I use? Should I use 8 into 7, 56? 8 into 6, what kind of days I want to figure out, right? So this becomes very confusing, right? So one way is you can put it 56, right? So 7, 8 and 56. Another way to do is, right? Another way to do is that stick to what convention they have given. If they have given weeks and months, stick to that. So how do you, now you go to weeks, and so here the numerator was 365 in days. Now let's convert the numerator itself in your uh, this weeks. How many weeks are there in a year, guys? In a year we have 52 weeks, right? So 52 by 8 minus 1. Similarly, the next convention is of months, right? Months is 1.1718. Now, months is how many? How many? We have 12 months, right? And 12, but we have 16 months here, right? So 12 by 16, right? And minus 1, right? So don't think that denominator will always be small. Nothing like that. There's no logic here. Denominator will always be small. Depending on the period we have, we'll just put it and we'll calculate, right? So that's what the whole thing is, right? So just understand that's the logic. Very, very straightforward. ETF1, how it is calculated, 365 by 125. If you go for ETF2, 52 by 8. You can do 365 by 56 also. I'm not denying, but 52 by 8 is better. And 12 by 16 is again better, right? So you're saving your time into, and then you realize that out of this, your biggest one is 13.37, right? So that is the highest annualized rate of return. Okay. Now let's try to solve this. The price of stock at T naught is USD T08.25, right? That's what we have. And T1, right? After 1 year, 1 month, whatever, the price has decreased to 186.75. The continuously compounded rate of return R1T for the stock from T0 to T1 is closest to, right? Now, see, we have been told to find the continuously compounded rate of return. Now, how do we find the continuous compounded rate of return? Which I told you when I have the initial price and the final price. Again, this chapter, since this is the first chapter, most of the things are directly formula based. And since CFA level 1 also, I told you very clearly, things are not that difficult. If you go back, uh, I told you, right, in the initial lecture only, it's all about breadth, right? You have to remember small formulas. And if you know that, it's not the depth. The CFA level 1 is not about depth, it is about breadth. It's a lot of formulas, right? So if you go back and see, if I know, so if you go here, uh, you see something where it is, see here, right? This, the ending value and the beginning value is given. You can calculate the RCC. RCC is equal to ln, which is natural log of ending value, beginning value. Use this formula, right? And this is the same. You have been given the ending value, you have been given the beginning value. If you use this, you can calculate the answer, right? So we'll do that. We have the ending value, we have the beginning value, we can put it, right? So again, I'm trying to uh, give you very clear RCC, right? RCC is equal to natural log. Ending value is what? 186.75, right? What is the beginning value we had, right? Which was 208.25, right? Just calculate this by calculator, right? So you'll get the answer. Very simple, very straightforward. Again, small things you have to remember, right? That's what we
So
have,
when
right?
will we use the ERT formula,
that,
exponential?
that can also be used, but not here, because that formula, okay. So both formulas are, to be fair, same thing, right? Let's do by that. So basically, R01 ln S1 by S naught, right? This is the formula given. So if I, let's say, multiplied both sides, I take it exponential R, right? And exponential I do, this goes away, right? So exponential I do this go, then it become S1 by S naught, right? So same thing is happening, right? So S1 becomes what? S1 becomes your S naught E R and T is 1, right? Because we are taking from T is equal to 0 to 1, right? So S1 becomes your S naught ER. We can use this also. Both are same things. Did you get my point? Basically, T is equal to 1. 0 to 1, how much is the time passed? 1 year, na? One year, 1 month, whatever it is there, right? T is equal to 1. The formula is what? Your S1 was equal to what? S naught ERT. Am I right? Or
Okay. Yes.
your future value was what? Your present value exponential RT. Both are same formulas, right? You can solve by this method also, right? So try any method. That is the beauty of mathematics, right? That you can apply any method, you reach the same place. Okay. So your understanding is totally right. If you want to use this method, you can use it. I'm just putting a point across that please keep in mind that T is equal to 1, right? Just don't forget to put, because there T is the time period between two events, right? So that T is equal to 1, R into 1, and that makes it S is 1 is equal to S naught ER, right? So you can put these values and you can find out. Okay, so that is done. So this is next question. Now the next question we have is, there's a USD 25 million equity portfolio is financed 20% with debt, right? Finance 20% with debt means here we have leverage return at a cost of 6% annual cost, means the borrowing cost, right? RB, RB is your 6%. Okay, and if the equity portfolio generates a 10% return, right? So 10% return equity portfolio generates, then the leverage return is, now we just saw the formula, right? If I go back, we just saw the formula before, you know, starting this numericals, that R V naught plus VB minus RB VB by V naught, right? So if I go here, so let me first uh, just put a circle on that. So this is what we are talking about, right? So R V naught plus VB minus RB VB, right? These all questions are from your CFA. So if you go to Schwezer, you will find that questions are a little easy. That's why I told you that, try to practice as many questions from CFA end of chapter. So that is what we are doing, and these are high quality questions. These are actual exam questions, right? So I don't want to give you a fake confidence that you go to Schwezer and solve easy question and you feel very confident about yourself. See, you should solve the right kind of question, which I told you in the first lecture itself. All these questions which we are including in our slides are not from Schwezer. These are CFA end of chapter questions, which are actually same difficulty level, which will come in exam, right? And which I told you very importantly that you must do it, right? So it's a very good practice you are having, right? R V naught plus VB minus RB VB divided by V naught. So this is what we need. So now if I go here, sorry, so now they have asked for leverage return, right? The leverage return, when I try to calculate the leverage return, again, it is R V naught plus VB, right? Minus RB into your VB upon your V naught, right? So 25 million equity portfolio is financed 20%, right? So the borrowing is 20%. Now, one way is that uh, I take the, okay, 25, the 20% of 25, right? If I take the 25, 20%, it means the 5 million is borrowed and 20 million is the original amount. So one way is that I try to take 10%, and then I say that out of 25 million portfolio, the borrowed amount is 5, right? Borrowed is 5 and 20 is the unborrowed part. So V naught is 20, VB is 5, RB is your 6% cost, which is 6%, right? And uh, VB is the amount which is borrowed, which is 5, and the total amount is your original amount is 20, right? V naught. So this is one way to solve. There is another way to solve, right? So if you solve this, you will get the answer. But what I want to tell you and show you, in fact, that there's another way to solve, which is not difficult, right? It is just that they have put the whole thing in a easier way, right? So this is easier formula, right? Again, what I'm trying to tell you, what I did just now, that will also get you the same return. This also will give, see, this is getting you, again, you can remember it. This is also giving you 11%. If I go back to our method, right, our method which we just did, if I go back to that, 10% of 25, what is 10% of 25? If I try to solve 10% of 25, 10% of 25 is 2.5, right? 2.5. And your, if I try to say that 6% into 5, 6 5 the 30, which makes it zero point 0.3, right, divided by 20. So it becomes your 2.2, 2.2 divided by 20, right, which gives me exactly 11%. I can find the interest rate by this method also. See, by this method also I got the 11% answer. My answer is A. Ultimately, you have to solve the question in exam, right? Question in exam, answer is A. But there is another way, same thing which you asked me, right? That's a, where will you use exponential formula? So you can reach at the same place in different ways, right? You can reach like this also. You can reach like this also, right? So whatever you feel like, right? Don't get surprised by seeing something which is very tricky or something and think that, oh, this is very difficult. No, right? This is not difficult at all, right? It is same answer either you followed my method of intuition or this method, right? This is again given in your book. If you want to follow this method, that is also good, right? These formulas are generally given so that student can directly apply it faster. But if you are not able to remember it, then also it's fine, right? You can use your intuitive way, which I just told you, that you are taking that, okay, this much is borrowed amount, this much is, right? So again, you get this same answer, right? Both case answer is same. Okay. Next one, an investment manager's gross return, right? Again, we cover definition. Is an after tax nominal risk adjusted return? No. Uh, Gross return is never after tax, right? We have seen it very, very clearly that the gross return is not a after tax kind of thing, right? So this is not done. The return earned by the manager prior to deduction of trading expenses. Now, this is very important, right? I told you very clearly. Gross return, will we deduct your commissions, etc., and trading expenses? Yes or no?
Yes.
Yes, right? So it's not prior to, right? So this is the trick part. It's not prior, right? This is wrong. Manager's gross return is an often used measure of an investment manager's skill because it does not include expenses related to management or administration, right? So this is the answer. Again, I'll give you one more hack, which I think forgot in the first introductory lecture, right? Which I always tell students, but I don't know why it's slipped from my mind, right? One thing which I'll tell you very clearly, that whether you are giving CFA, right, whether you are giving FRM, any exam you are giving, right, please understand that the when you're solving questions, right, when you're solving questions, A, and you have three options, A, B, C. Your objective is not to find the right. See, if there are two kinds of question which can come in exam, right? One is numerical, right? When you are getting a numerical question, then my pen is getting problem. But when you are getting a numerical question, right, then it is very straightforward, right? If you know the formula, you calculate, you get the answer. So numerical question, calculate and tick mark. Right? Calculate and tick and move ahead. Right. But when it comes to theory, I'll give you a hack. The hack here is that please understand, in CFA, I'm giving you a very controversial statement, but please imbibe it. What I'm trying to say is that when you're doing CFA or any exam like FRM CFA, your objective is not to find the right answer. Your objective is to eliminate. Right? Always remember that objective is to eliminate the options. So you always progress like this. You read an option. If you think that option is correct, especially theory, you keep it. You don't tick mark and move it. You keep it. Then you go to next option. You read it and you find, oh, this is wrong. Then you cut it. Then you go to third option. You read it and then you cut it. So after your whole exercise, the option which you are not able to cut it, that is the answer, right? So never ever solve a question in theory where you just tick mark the option that, oh, this seems right. You never know, there is a small error there. So best way to figure out is, which I did just now, right? And the focus should be on elimination, right? That, okay, after tax nominal, no, it is not after tax. So you are eliminating the option, right? My objective is not to find the right number. My objective is, okay, this is wrong, after tax is wrong, this is wrong, prior to deduction, this is wrong. Then I'm very clear now, right? These two are totally wrong. Now this I have not even heard before, right? This third statement I have not heard before, neither I taught you before, right? But since I am very clear that these two options above are wrong, this I can easily tick mark and this is the answer, right? So what I'm trying to say here is that a good student will not, especially in theory question, will not look for the right answer. He will look to eliminate all the wrong options, and what is remaining after elimination, that is the right answer. Okay, so go in that way. That's a very good hack, because that way you do lesser mistakes. Otherwise what happens is you make more mistakes, right? So always try to eliminate. Once you eliminate, the pending one is your answer. Okay, so this is the answer you have. This is the explanation which has been given. Gross returns are calculated on a pre-tax basis. Expenses are accounted for the change imputation of gross return as they contribute directly. Right? A is incorrect because gross returns are pre-tax, not adjusted. B is incorrect because managers do reflect the deduction, and same thing which we discussed. Okay. Moving on, I think we have one or two more questions, then we are finished with this chapter. Okay, the strategy of using leverage to enhance investment returns. Right now, again, it's a that's why I went to derivatives to teach you, because that is what you need to know very very clearly here. That why do we have leverage, right? Why do we have leverage in futures and options? Why do we read statements which come in newspaper that SEBI has said that 96% of investors who trade in futures and options in market lose money, right? Because leverage is a sword, right? Leverage is a sword which works either way. You gain and loses both sides, right? So it is saying leverage amplifies gain but not losses. Wrong. It can amplify your gain because you're taking a 15 lakh position with 2 lakh rupees. So if you make profit, you will make more profit. If you make losses, you will make more losses, right? So that is what we have, right? So this is wrong. Doubles the net return if half of the invested capital is borrowed, right? Now this part is doubles the net return, right? See, there's no surety of doubling the net return. Leverage does not give you sure return, right? Leverage only gives you that you can make that return. You can double the loss also, right? So that is also doesn't work out. Increases total investment return only if the return earned exceeds the borrowing cost, right? Return earned exceed the borrowing cost. That makes sense. That is why we have the formula for leverage return when we talked about. That is what we have the formula now, which was that R into V naught, right, plus VB. And that's why I was subtracting. Only if the return earned exceeds the borrowing cost. That's why I had RB into VB, right? This was the borrowing cost, right? This RB into VB is the borrowing cost, right? And you are dividing it by V naught. Right? This is the borrowing cost. Okay. This is the borrowing cost we are talking about. Right? Again, so this is the understanding of formula you need to develop. Again, conceptual understanding is the key. Okay. All right. So the same thing here, same logic. The use of leverage can increase investment return if the total investment return on the leverage investment exceeds the borrowing cost on debt. A is incorrect because leverage return amplifies both gain and losses. I told you. B is incorrect because if half the invested capital is borrowed, the investor gross, not net return, right? Investor gross return, not net return, would double, right? So this is also actually option B was tricky. Option B we eliminated very fast, but it was very tricky. It not the doubling of the net return. It is doubling of the gross return, right? Not the net return. So actually, option B was quite tricky. We eliminated, but not on very sound basis, right? So not your net, right? So gross return doubles, right? So that's what we have. I think we have last question now. Okay. So the last, I think this is the last question, if I'm not wrong. Yeah, this is the last question we have now. So at the beginning of the year, investor holds euro 10,000 in a hedge fund, right? The investor borrowed 25% of the purchase price, euro 2500 at an annual interest rate of 6% and expects to pay a 30% tax on the return she earns from his investment. Now, this is very tricky, guys. He always, last one or two questions which is given in the CFA end of chapter, those questions are generally tricky because they are trying to generally add two, three concepts together, and that kind of creates a lot of confusion. Okay, so keep that in mind. So what is given here is that you have borrowed 25% of the purchase price uh, at an annual interest rate of 6%, expect to pay 30% tax. At the end of the year, any hedge fund or the hedge fund reported gross return this much, trading expense this much, managerial and administrative expense this much. The investor's after tax return on the hedge fund investment is closest to. Now, this is a very tricky question because there are two, three concepts involved here. Generally, such kind of questions, like I'll tell you very clearly, the last one or two questions of every chapter, every end of chapter, last one or two will be very difficult, right? But the good point to note is that those questions will be like 10 to 20% of exam only, right? Not much, right? So what I'm trying to put across is that if this chapter has two questions come, three questions coming, this question uh, will be only one, right? This kind of question is only one, right? Because this is complex. This is like you're incorporating many things together. Okay. Now, what you will do in this question, right? First of all, there are a lot many things moving wheels here, right? The first step here is to compute the investor's net return from the hedge fund investment, and the net return is the fund's gross return minus your managerial and administrative expenses, right? So your 8.46 minus 1.6. So net return we have to calculate. I'm putting NR, right? So net return is equal to 8.46 minus 1.60, right? So this is what we do. So when I do 8.46 minus 1.60, right, I get 6.86, right? So this is the first step we have to do, right? So we have moved from gross to your net return. Okay, this is the first thing I have done. Now, after doing this, right, uh, please note that the trading expenses are already reflected in the gross return. So they are not subtracted, right? Which I told you very clearly that you will be, they will try to confuse you. Now you will be thinking that, sir, why have they given the trading expenses? This trading expenses are given just to confuse you, right? These are given, this is additional information which has no use in this question, right? This is to confuse. Because I told you now that gross returns will be calculated. You know, gross returns will already incorporate the trading expenses. Yes or no? That was said, na? So right, this was already incorporated. So this is just to confuse you, right? The student who doesn't understand this concept will fall for it, right? So the second step now is to compute the investor's leverage return, where we are saying that investor borrowed euro 2500, which is 25% of the purchase. So when you have this thing, then if you remember the formula, this is where the that formula generally helps you. Again, you can calculate by both methods, right? There are two methods here. You don't have to follow any method what you want. In fact, we can go to the next page just to do it faster. So I've explained you all the above part, that first you calculate the net return which I told you, and then don't worry about your trading expenses. The second step is that you use this formula, right? This formula I told you, it's easy formula. You can use another formula also which I told you, but there for then you have to do what? Because 2500 is 25%, right? So then you know that okay, if 2500 is 25%, then you know that 7500 will be 75%, right? Then you know the total amount is 10,000, right? So you can do that way also with what I told. So you either use this formula or you use that formula, whatever you want. So you can use my, I'm just one. Let's look at this one, then go to my formula. So this was given 6.86, which I found by net, and then 25 by 7500, and RP minus RD, right, which is borrowed cost, and 7.15, and then you're applying the tax rate on that, right, final tax rate after that. Because tax is applied after you have calculated the leverage return, right, not before. After tax return is after that. Now, by my way, right, what I told you earlier, that way also you can calculate. It's not difficult, to be fair, right? If I do it the other way, right, which we saw. So if I have your, what was it? R into your V naught plus your VB, right, minus RB into your VB and divided by your V naught. So R was what here, right? What is the R here? So R in this particular case, right? In this particular case is your initial, right? Initial, your the the initial amount we are talking about, right? So you can, again, V naught is what, 7,500 below. That is one we have. Then V naught plus VB is your 10,000. Okay. Minus RB, borrowed amount is done at your 6%, 6%, and you are doing it at 2500, right? And this is your R, right, which was the initial one, 6.86. So if you calculate by this way also, you will reach at the same thing, 7.15, right? So whatever way you follow, right, what I'm trying to say, you can try this method also, you will reach 7.15%, and then you take the after tax, which is your 1 minus 0.30, right, 5%, right? So two three concepts, not a very difficult question, but the key point I find in this question, right, which is very important to understand, is that lot of students get confused by this trading expenses. Trading expenses part has no use in this question, right? No use. This is extra information given just to confuse you. No use in this question, right? So keep that in mind. Okay. But yeah, so go back and practice. That's my request here. That these questions are not tricky. These are all very good questions taken from your CFA end of chapter questions, so high level questions, and we have done almost all of them, right? Almost 13 questions, right? So a good practice, good revision, and you have now seen that it is, there are a lot of small things you have to remember. That is what is your CFA level one. CFA level one is all about breadth, right? The depth is not much. It's not that you're getting into huge complex things. The small things, small formulas you have to remember, and your mind should be sharp enough to remember those and immediately use them in a certain context, right? So that is what the whole game is. Okay. Any doubt here?
No, thank you so much, sir.